Hello, everyone, and welcome to CPAacademy. My name is Christine, and I will be your moderator for today's premium webinar on what's new with the Paycheck Protection Program, what clients want you to know. Before we get started, I'd like to do some technical checks with all of you to make sure everything is working and good to go. I'd like you to head over to that questions box on the gray GoToWebinar control panel and just shoot me a message and let me know that you can hear me and you see the title slide and the faces of our presenters today. And while you're there, let me know where you're tuning in from. Hello from Whaleyville. Welcome, welcome. Thank you so much for letting me know. California, Nashville, Colorado Springs, Indiana. Awesome, and you guys are flooding in now. All right, so if any of you are having any technical troubles today, you can let me know in that questions panel and I'll make sure to help you out. This is also a great spot to put your questions and comments for our presenters during the webinar. All right, now let's go through some housekeeping for credits. This is a 1-hour webinar and it qualifies for 1 CPE credit. And in order to earn the credits, you must stay logged in for 50 minutes of our allotted time and answer the poll questions. Those questions are going to pop up on your screen throughout this webinar, and you're going to have approximately 60 seconds to submit your vote for each question. We'll have 4 polls total throughout the presentation, and to earn the full credit, you'll need to answer at least 3 out of the 4 polls. CPE will be issued by the end of the day today, as well as a recording of today's webinar, and both will be available in your CPAacademy accounts. We recommend that you take the time to download today's presentation materials, which can be found in the handout section of your GoToWebinar control panel. You might see 2 duplicate documents, but they are the same, so just download one of them for today. And now that we're all set, let me turn it over to today's presenters, John Comunale and Tom Hudson with Counselor Buchanan and Mitchell. Welcome, gentlemen. The floor is all yours.
Thanks, Christine.
All right. Now, as we hop into this, here's some pictures of John and I, just in case you wanted to verify our identification against our actual professional headshots. We are who we say we are. But I'm Tom, and this is John, and we're going to speak to you today about what's new with the Paycheck Protection Program. We're just going to go through a lot of the different things with the PPP. We're going to talk about 8 weeks versus 24 weeks. We're going to talk about the application itself. We're going to talk about the eligible expenses. And then we're also going to kind of go through and think about the best ways to leverage the program and the best ways that your clients can utilize the program. And then we're going to try to give you guys as much information as we can with some Q&A. And if you guys have any specific questions, we'll try to handle them as efficiently as possible. So just things we're going to discuss today, just covered them. Here they are. One of the things also will be future legislation. That's very important as this program is ever changing, as I'm sure a lot of you have seen in the news, and Congress is always talking about changing it more and more. So here you go, John. Let's start with the overview.
It seems like a lifetime ago, March 27th, when the FBA introduced the Payroll Protection Program. There have been a lot of changes since then, although I believe in the last 4 weeks, nothing really has changed at all. But initially, when it was passed, it was a 75-25 payroll cost ratio for full forgiveness. One important item that we're still waiting for guidance. April 30, the IRS declared that these expenses are not deductible, and that goes way back. I forget the section for the IRS, where any expenses related to debt forgiveness cannot be deducted. There is a bill in the Senate, and top-ranking Republicans and Democrats both want the bill passed, and they fully feel that the intent of Congress was to make these expenses deductible and stimulate the economy even more so. So right now, can't do any tax planning, and hopefully they will pass that bill and give us plenty of time to take into account. There's always a lot of uncertainty, not uncertainty, but just gray areas from the day it was passed, and it was constantly changing. So, you might have told one thing one day, and the next day it was changed. So the biggest change came on June 5th when they passed the Flexibility Act, and they're making every attempt and intent for these expenses to be fully forgiven. As they, it was all new to them, and as they go through it, the SBA really wants you to have full forgiveness. So the big change was the 60/40 payroll cost to other expenses for the forgiveness. And then it extended the safe harbor deadline from June to December 31, which I think gives, a lot of flexibility and enables you to make sure that you have everything in order.
Yeah, and a lot of the results of these changes were from Congress trying to implement their will against SBA and IRS. So some of these bills, like the Flexibility Act, SBA originally interpreted the CARES Act and said, we think 75/25 is a good ratio in which payroll costs should compose the usage of all of the dispersed loan funds. Congress didn't like that. They thought that was a little strict. So that's when they came back and they came out with the Flexibility Act with an actual law that said it needs to be 60/40, because before, as I said, it was SBA's interpretation of a good ratio. Congress came back and said, we want it to be different. So they passed a law that says so. And the SBA, of course, will have to interpret the law as it's written. Also, with the safe harbor deadlines, when they extended that out to June, I think that was Congress realizing that this pandemic was still happening and businesses were still shut down. Something that we, of course, didn't know back in March how long this would last. So I think they're trying to give everyone more time to get it going, and that's the intent.
So the more changes on the Flexibility Act from June 5th. 8 covered period is extended to 24-week covered period. It gives you, it goes the guarantees, I think, that you should be able to get 100% of your loan forgiven by using the 24 weeks. And, loans prior to June 5th could also elect the 8 weeks instead.
Yeah, that's important. That's an important one. Let me jump in real quick, John. 8 weeks is only available to people who had loans before the Flexibility Act. So everyone has the question of 8 or 24, but if you went and applied for a PPP loan now, which they've extended all the way through August, the first week of August to apply for one, you will only have the option of 24 weeks. So that's an important stipulation for folks. Even though 24 weeks, we'll get there discussing the pros and cons of each, but in general, that's the one you want to go for. But just FYI, you can't get 8 anymore.
We already went over the 75/25 is now 60/40. The safe harbor full-time employee deadline is extended from June 30 and all the way to December 31. So it gives you plenty of time to restore your employees, and as we'll go over later in the presentation, that full-time employee cutoff count would be done at any given time during the 24-week period, but we'll follow up on that later. Now you have about 5 years to pay the loan, and the loan amount would only be the total that was not forgiven out of your total loan. I believe the interest rate is 1%. It allows a payroll tax deferral for PPP borrowers that receive loan forgiveness. So that is also eligible. Initially, it wasn't.
And one more point on number 4, the time to repay the loan. The maturity date was changed in the Flexibility Act to 5 years. And if you had a loan prior to that period, prior to the Flexibility Act, you have currently a 2-year maturity loan. You have to contact your lender to have that extended to 5 years if you wish to have the longer maturity. That's something that you're going to have to work out with them. I believe it's just a little bit of paperwork, but just know that that's one of the only things that wasn't an automatic change for folks who have loans.
certification safe harbor. Any borrower that, together with its affiliates, receive PPP loans with an original principal amount of less than $2 million will be deemed to have that loan applied for in good faith, which seems to lead that you have you will probably not be looked at if your loan amount is under $2 million. And when it says together with its affiliates, there are some industries that even a controlled group, a common ownership, they might have received in total more than $2 million. But under the affiliate rule, if you are a franchisee of a franchisor that has a franchisor number, all of your companies, as long as they're under 500 employees, will be deemed to be separate, and only the $2 million will count against each company. So if you're over the $2 million, you still fall under this safe harbor rule. But the SBA still, can renew a PPP loan of any size, and I believe is a 6-year period that they after you obtain the loan, that they can come in and look at your loan. They recently, from just maybe a week, 10 days ago, put out a list of loan recipients over 150,000. So that's public knowledge now. And I really haven't heard anything, that I haven't seen, not a lot anyhow, of feedback or concern over certain industries or certain businesses getting loans. At least in my experience, all of our clients, applied for these in good faith. Back in March or mid-April, the uncertainty of where things were going caused them all to apply, and I feel all of them were in good faith. So I'm not, I don't think I'm very concerned about this, but we'll see.
Yeah. So one of the things that we wanted to cover today, hey John, will you turn your volume down? I think there's an echo coming from a little.
There is. So John, do you have any headphones available that we might be able to plug in? Because I think it's the audio from the computer.
No, I didn't bring them down to the office. They're at the home. Can you still hear the echo? I turned my volume down.
Okay, I'll just keep going, and if it comes back, then we'll ask you to just try to turn it down a little more. Okay, so we're just going to move on here. One of the things that we're supposed to be covering for you today is 8 versus 24. We talked about it before, who can have 8 weeks and who can have 24 weeks. That has to do with the date of the original loan, whether or not that option is available to all of the loan applicants. And it has to do with whether or not their loan was before the Flexibility Act or not. So if your loan was before then, you have option of 8 or 24. So which one are you going to choose? So 24 weeks in general, it just offers more time for all of you all the loan recipients to utilize all of the funds. It makes it a lot easier in that you have triple the amount of time to pay all of your employees. And as we'll discuss later in the presentation, we're going to look at the salary caps for non-employees and employee owners, or strike that as for employees and then also owner employees. There's 2 different distinct sets of groups that have different caps. So those caps, the amount that you can use the funds for each individual, they'll triple with the term of the loan as well. So that's something that allows you to make this simpler, and that you don't have to worry about the non-payroll costs as much. If rent is something that's maybe a large expense for a business, then of course, by all means, go ahead and utilize it. But you can make the application much more simple for yourself by just having payroll paid to all of your employees, and then all of your loan could be forgiven under just simply payroll costs. It reduces the amount of documentation that you're going to have, and it just makes the application easier, and it makes it a general process that gets a little bit, there's less reliance on the non-payroll costs, which it's not a bad thing if you have those, but it just makes it easier and at a higher level. One of the questions that we have coming in here, and it's a very good on-point question. Someone is asking if the client maintained payroll and their FTEs until now, is it possible for them to reduce their FTEs before December 31st, 2020? Or do they have to keep the FTEs all the way through the end of the year? To be very clear, you can apply for forgiveness before the end of the 24-week period. The latest IFR that came from the SBA, and their interim final rules are how they release guidance and clarification about how to actually do all of this and how to interpret all of the rules and what's good and what isn't. Has a lot of examples in it. So as you start to go through helping your clients with these PPP loan forgiveness applications, you're definitely going to want to take a look at a lot of the IFRs that have been released. And SBA is in the process of going backwards and editing all of those right now to update the information that was released, because it came out slowly ever since March. I mean, that was 4 months ago. So there's some things they have to go back and change, but for the most part, they give you clear rules about how this works. One of the recent IFRs says, related to this specific portion, this specific question, is that you can apply before the 24 weeks, and any FTE measurement will be based upon the date of which your application was submitted to your lender. So if your client made it through 12 weeks, used up all of the funds, they don't have to wait until the end of the 24-week period to apply for forgiveness. They can go ahead and apply now, whether it's 12 weeks, 13 weeks. It seems to be the sweet spot for a lot of clients who have utilized all of the funds. That is the date for which you're going to make sure that you didn't have an FTE reduction, that 12 or 13 weeks or whatever period you're at. There is one major caveat, and that is you're still subject to salary reduction throughout the 24 weeks. So when you apply early, what you're going to say is, I haven't reduced my FTEs through my application date, and I will not decrease anyone's salary beyond 25% throughout the 24 weeks. How all of that is going to get handled administratively, I'm not sure. I believe it's you making a promise, and if you get looked at and you got caught, then that would end up with repercussions. I'm not sure how all of that will work, but the IFR says if you go ahead and apply before the 24-week period, you can decrease your FTEs after your application, but not salaries beyond 24 or 25%. Make that very clear. That's a very important point. So December 31st, everyone's focused on that date. It's a drop dead date. December 31st is the last possible date that you can use to achieve that safe harbor by bringing employees back. So on your application, you're either going to have the date of the application for FTE reductions or December 31st. You have to have the employees back by then, otherwise you can't obtain safe harbor, and you would be subject to a reduction if you had a reduction during your covered period. Pretty complicated, but really the main focus is if folks are done early, they'll go ahead, select 24 weeks, and they'll apply and use the FTE reduction measurement date of the date of the application. All right, so we have our first polling question, and Christine, I'm not exactly sure how we need to.
I got it. We have launched it. Yeah, we have launched it, so it should be on everybody's screen now.
Okay, so our poll question, I'm gonna go ahead and read it. It's how prepared do you feel to answer a lot of these questions for your clients about the intricacies of the PPP loan forgiveness process? Are you super prepared? Are you an expert? Should you be giving this presentation instead of me? Are you somewhat prepared, or are you just not prepared because you were wrapped in the weeds in tax season and you didn't have time for this? So go ahead and let's get some answers in. Let's get that CPE.
Got about 20 seconds left here, everybody. All right, if you're hearing my voice, we have launched poll question number 1. We'll have 3 more questions left for the remaining hour. Be closing the polls in 3, 2, and 1. Back to you.
Thanks. So do we get to see any of these results, or if anyone throw out there in the chat how they're feeling, just give us a good feeler of where everyone's at.
You got it, Tom. It should be up on your screens now. It looks like 79% said somewhat prepared, 11% said not prepared, and 9% said very prepared.
Oh, that's pretty even distribution right there. Okay, all right, that sounds good. Somewhat prepared. I mean, that's good, because that means that a lot of you guys are in tune with some of the details associated with the program. It gets quite complicated when you really get into the weeds and when you start having to actually apply all of these rules for your clients, because a lot of these businesses, one size does not fit all, and that's what this program is from Congress. It's this one big solution that came out and is supposed to easily make sense. But you've got businesses who have non-standard work weeks. You've got businesses with all different types of employees who earn their money in lots of different ways, and how their compensation is structured is quite difficult. And just fluctuations from 2019 to 2020, a lot of businesses, when you applied, it was based on logic from 2019, how many employees and salaries as of then, and then we come into 2020 and you have to incorporate 2019 information that may be out of date. And they try to account for that, but sometimes these situations stick out that make these applications real head scratchers. So we'll try to cover those, and if you have questions, we'll try to take a whack at it. We've encountered a lot of them, and we've been assisting our clients through the process. So any questions, throw them in the chat. Now, one of the things that we were talking about before were the payroll limits. So for owners and owner employees and self-employed individuals, those are all owners of a business. That's whether somebody's self-employed as a sole proprietor, that is somebody who's an S Corp shareholder, a C Corp shareholder. Those fall under this definition, a partner in a partnership. These are owner employees or self-employed individuals. They have different caps, and they get accounted for on the application in a whole separate box. You're going to have on the application, we'll show you later, there's one box where you put all of the employees who are not owners, and you do all of the math and calculations for them. And then in box 2, there's one where all our owners need to go. And then there's also another separation for folks who are capped on the $100,000 and those who are not. So you need to be aware of those differences, but non-owners is really where it helps to support a 24-week period. If you have a lot of employees that you're paying, you can see there that the 8 versus 24-week salary caps, that's $100,000 annualized salary. And you can use up to $46,000 of your payroll of your loan for one employee. So that's something that helps with 24 weeks. It was really hard originally to get everything crammed into 8 weeks, especially when you're running into compensation caps at $15,000, because a lot of organizations receive sizable loans. So giving you the opportunity to pay employees a significantly larger amounts with the 24-week period really helps you achieve that loan forgiveness by using more and more of the money on payroll. So when you fill out the application, nobody should be higher than these amounts in the payroll cost charts that you'll be filling out, those specific worksheets. You don't want to see compensation amounts greater than this, because that means somebody is over one of the limits. So you need to know these limits. You need to look for them on the Excel sheets that you're going to be passing around with your clients. So when we talk about owner employees, the cash compensation for all of them and the caps that we just showed on the previous slide, they are different depending on the type of entity and the owner of that type of entity. So if you're self-employed, you can include in that cap your health insurance or your retirement. They say that those things are paid out of your net self-employment earnings. That's what the SBA has said. So therefore, you can include it in your cash compensation replacement, which is a unique term that they generated for self-employed Schedule C proprietors who are filing under that specific type of entity. General partners, same thing. They said the same logic applies. So general partner, you can't include your health insurance, you can't include your retirement. When you get to S Corp employees, you can include their retirement, but not their health insurance. C Corp, you can include all of it in that compensation cap. So how is that different from the rest of the employees? All the other employees can have all the way up to their caps in just cash compensation, and then their retirement benefits and health insurance benefits on top of that amount. So their payroll costs could actually be beyond that amount, but you have to focus on cash compensation being capped. The other things are additional. It's different for owner employees, and it follows the logic on this chart. Be aware of that. It's something you're gonna have to focus on. And while it's kind of bad for the owners of the businesses, who are the folks that we're working with most of the time, unfortunately, these are the rules. And these can also fluctuate based on 2019 earnings. So we're talking maximum caps. That was an important item I didn't cover on the last slide. We can just hop back. But to be clear, these here for the owner employees and self-employed individuals, that's assuming that last year their income was beyond $100,000. Otherwise, if it's less than that, you start reducing that cap proportionally. So it's something also that you have to worry about. Eligible expenses, I imagine this is one of the things that all of you are really in tune with. And if there's anything to be familiar with, it's what these payroll costs are. It's salary, wages, bonus, tips, gross commissions, and it's essentially the gross pay for all of these individuals. You can't include the employer portion of the payroll tax, but everything else, gross pay to the employee, is good to go. There's also allowances for dismissal or separation. There's a few areas where SBA and Congress realized, hey, you know, these are still businesses, people are going to leave, there's going to be movement, there's going to be turnover. There are exceptions provided to employers for folks who leave, whether if they're fired for cause or if they just leave for another job. You don't get penalized for your employees going through the natural movement of careers. So that's something you can factor into the application. You don't get any type of FTE reduction for those, and there's a special system that's explained in the instructions as to how to do that. So you'll have to look there. You can include payment for vacation, family, medical and sick leave, healthcare benefits, retirement benefits, those are all included. And then any state and local payroll taxes that you incurred while paying those employees, that can be included. Really minor, but it's in the definition. Non-payroll costs, very specific here. We've gotten a ton of questions, and I'm going to share a bunch of the ones that we've gotten from our clients about, hey, what goes in this non-payroll? What can go into the non-payroll costs? It's mortgage interest.
Tom, can I enter on the mortgage interest? If anyone listening has clients with floor plan interest, that is not. We're still waiting for an answer from the SBA on whether floor plan interest is eligible to be applied against the forgivable expenses. I mean, we've been trying to get answer for a while, but that hasn't come out yet.
Yeah, so it's mortgage interest that you can account for, and the mortgage had to be in place before February 15th, 2020. So they're looking for it being established before the pandemic happened for it to be eligible. Rent, it's important to have lease agreements. If you don't have a lease agreement, you might be in trouble. Any type of payments in accordance with that lease payment. So we had one client who had all the operating expenses and the property taxes broken out of that on that lease. And I think that might have hurt them a little bit because only the rent is actually included. So versus a lease where you just pay a flat $50,000 a month or something along those lines, that could all be included, even though you're covering indirectly the the property taxes that the tenant, that the business, the building owner is incurring and stuff like that. So you need to focus on how their lease is written up and what's broken up and how the expenses are necessarily covered there. But rent under a lease agreement is eligible as a non-payroll cost. Utilities, this is where everyone throws all the questions in because there's an et cetera in the actual definition. So they kept it broad, but they also came in and did name a few. Initially, it was just gas, water, electric as a utility, but they added transportation, telephone, and internet access. So everyone was questioning, hey, is my internet bill count? I mean, we're all paying internet, and then cell phones. That's different than a telephone technically. I think it's all good to go. It should be eligible. It's up to the bank to decide. But as I mentioned earlier, when you select that 8 versus 24-week period, it makes these non-payroll items less important. But if someone is in the situation where they have to use these expenses to get their forgiveness and it makes up a big portion of the usage of their funds, it becomes more important. So the definition for utilities is quite broad. I think it's really, if it's something that isn't explicitly named or doesn't fall under one of these categories, you're gonna have to make a decision and communicate with the bank about what they think. The bank for the specific lender that you're working with. Some of the questions that I was talking about was 2019 retirement contributions. Everyone was saying, hey, this is a payroll cost that, you know, I incurred back in 2019, and they happened to pay it, you know, here in the first to beginning second quarter of the year for last year. Once they finally got their 2019 tax return done, they figured out what that amount has to be, and they're trying to make that payment. while it does seem a little extreme, I think it does meet all the definitions. It is a payroll cost and it is a retirement cost. I feel like it does seem excessive, but per all the rules, it qualifies. So we've been saying if you're making a large retirement contribution, we think that's an eligible expense. Some people may disagree, and SBA may finally come out and clarify yes or no on this specific issue. I don't know if they are aware of it or not, but it's just something that we've encountered a lot from our clients. Like, does this count as a payroll cost? Maybe less so now that 24 weeks is available, but this is something we've been receiving as a question all the while. Everybody is, as I said, coming after us with, well, what about this utility? What about that utility? We've had it all. Different types of expenses. Somebody's talking home security for a security system for the business. It's not really named, but we would all call that a utility, maybe. Some people do, some people don't. So as I said, it's up to the lender when they approve the application. And I don't know if that actually qualifies, but I'd be willing to wager it does. So you're gonna have to work with those and really use your judgment. Hopping along here, I see one of the questions here. How do the payroll limits work for self-employed and S-Corp owners? If the business applies before the end of the 24-week period, is it based on what their 2020 payroll, if W-2 earnings, or from 2019 earnings? Okay, so when you apply, you're going to be focusing on the expenses incurred during the covered period. So that would be the 2020 payroll W-2 earnings for an S-Corp owner. It will be limited based, that the amount eligible is limited based on the 2019 W-2 amount for that specific S-Corp owner as well. So that's something you're gonna have to look at. It gets limited by what the pay was last year for the owner, but when you're reporting on the application, you're going to be focusing on how much you spent this year, of course, subject to the limits imposed by 2019's income levels. I hope that answers your question. So the applications, with the Flexibility Act, they came out with Form 3508, that's the number, SBA Form 3508, don't go looking for an IRS form. We're in a separate rule area than we're used to working in with SBA law and their code, but there is an EZ version, and they wanted to introduce this EZ version to make it easier for the banks, I imagine, because they are going to be overwhelmed. And you can use the EZ if you're a self-employed individual, contractor, sole prop, so if it's just you. If it's just one person, they can go ahead and use the EZ. And you have to meet one of these criteria, either 1, 2, or 3 listed on the screen, in order to use the 3508 EZ, not all 3. If you were a business and you didn't have any salary or FTE reductions at all, you know that you didn't cut anyone's salary, you didn't lose any people, this will be very useful for smaller businesses who maybe had 5 employees and they kept them on the whole time and they used all the funds appropriately. You can go ahead and use the EZ if you meet that criteria. If you have a bunch of reductions that you're looking at and you start getting into safe harbors and all of that, you're precluded from using the EZ and you're gonna have to look at the longer form. Third, if you don't have any reductions and you are unable to return to the levels of activity measured before February 15th. This has to do with one of the new things that the Flexibility Act added. It added a brand new exception for businesses that allows them to not be subject to FTE or salary reductions if they were prevented from coming back to levels of business activity that they were at pre-pandemic. I think this is focused on a bunch of different industries, maybe ones that were all shut down just broadly and they had a storefront or something like that, or a restaurant, and they were told by local authorities, you can't open, I'm not allowing you to open. Obviously, you're gonna have cutbacks. Some of the employees just can't be paid. Some of them are gonna go on to unemployment and perhaps reject your offer to come back to work. And that is an exception as well, by the way, you just need to document it. But if you just if your client couldn't open at all, they are eligible to use this. They are eligible to use the 3508 EZ, but they had to have not had any reductions. So in most cases, that's going to be the clients who just paid their employees anyway. But that's another thing to think about. That big exception is going to be something that's more of an argument rather than fact-based, and you're going to have to help your clients really present that argument well to the SBA if you're utilizing that specific exception. So if you don't meet any of these 3 criteria, you're going to be using the long form. It's not that bad. It's not that much worse. The easy was really just kind of a shortcut, making it that much easier to do. You still have to do all the behind the scenes math, but it's just easier to fill out in that you don't have to submit as much information to the SBA. You need to have it on hand, but you don't need to send it in. And if you're looking how to do each of these, there's detailed instructions from the SBA on both of the forms. They explain how to go through it, the logic behind every line, and that's going to be your guide through the applications. So filling them out. This is kind of a picture of one of them, the long form, and these are the boxes I was talking about here. This is where you're going to spend a lot of your time. This is where you're going to list all your employees that you employed during the covered period. You can select that alternative payroll covered period. That's more for just administrative ease. I don't see much benefit to it because the language that says paid or incurred about the payroll expenses, they can fall in your covered period. We kind of get the best of both worlds, cash basis and accrual, in that you can accrue payroll costs that you incurred at the end of your window. And then if you had a payroll that was before the date that the client received their loan, but then paid inside the covered period, that can be included as well. So the APCP, the alternative covered period, it's slight benefit, maybe just administratively easier. So if anybody received compensation from you and they're under the $100,000 cap, at any time during 2019, you're going to put them into this. You're going to put them into this specific section of the application. You're going to put their name, their identifier, and their cash compensation, and you're going to do all the math behind the scenes to calculate their average FTE number. You're going to total it all the way down to the bottom for box 2, and this is per employee. So if your client has hundreds of employees, you're going to be doing this on a very large scale. But look for payroll companies to assist you here. A lot of them, I know the big payroll companies, they have reports available that really have built this information based on what you've been submitting for the payrolls to be run. So if somebody is in that situation where they have a ton of employees and they use a big payroll company, it's going to be quite easy because they should have reports that you can easily dump into the application that are accurate. If somebody doesn't use payroll and they run it themselves, it could be a little more labor intensive. So that's something to think about. But this is what it looks like. This is where you're going to be filling it out, and this is what the application will be requiring you to fill in. So I have a question here. Can we include employees on the forgiveness application that were not included on the original application? For example, they hired additional employees after the application, and one was omitted as a part-time employee, so they didn't believe they qualified at the time. Okay, so 2 things. The loan is tied to the position, not the individual. So if somebody left and you replace them with a new person, they can kind of fill that slot and utilize the funds that were designated technically for the employee that departed. Part 2, if you have more employees than you did during the 2019 measurement period that you used to apply, then you're golden because you can spread those costs out. You should have higher FTEs, which of course wouldn't be subject to any reduction, and then salaries of course should have not been reduced. So you can utilize those funds faster if, say, you had 10 employees during your covered period when you applied for your loan with 5 employees. So it's definitely a benefit, and of course they want to see businesses thrive. So there's no penalty, nothing that prevents you from doing that, and you should be in a good situation. What you're talking about a part-time employee. So what's weird about this FTE thing is that when these clients applied for their loan application, for their loans, they used a different definition for FTEs than what is actually being used on the application. We get down to that in a few slides, but the logic is completely different. On the application for an actual loan, they said an FTE is everybody. I don't care if they're part-time, if they work 1 hour, if they work 2 hours, or if they work 60 hours a week. You are just going to count them as 1 FTE. So it was kind of frustrating because people learn that definition and then think it applies for the application when it really doesn't. I got another question. I see that we're using 2019 figures. We started business in 2020, no payroll in 2019. How do you fill this form out? So the rules for newer businesses are completely different. I haven't focused on them a lot because I haven't run into that situation myself. But for newer businesses, they're different. They have a different subset of rules. They had a whole different set of criteria when they applied for loans. You focused on kind of the beginning of the year in 2020. So the first quarter, I believe, is where the ranges are that the application was asking about. And that's all I know from off the top of my head. Filling this form out, it's going to be different. And I can't speak to that right off the top of my head. I have to look into that, but I know it's different and you're going to be following a different set of rules. So I know that's not the best answer, but it's all I can give you at this point in time. Yeah.
We have a client who purchased an existing business assets in March, and their SBA banker told them to use the information from prior business, and they allowed them to apply for a loan even though they just started. So I mean that might help in the situation.
Yeah, maybe. So moving on, we've got another box here. This is for folks who are over $100,000. So the ones that are going to be subject to the cap, they go in their own box. They wanted it separated out that way. So that's something to be aware of. We've got another polling question.
All right, poll question number 2 is up on your screens now. You have about 60 seconds to get your vote in.
Yeah, so where are you guys looking for information? Are you doing webinars such as this one? I know there's a ton of people writing on this right now, a lot of the good tax minds who are putting a lot of focus on this, not as of late, because SBA has been kind of silent the past 3-4 weeks, which is confusing because we have a lot of questions we want answered.
And also Congress, they'll be in recess sometime in August, so we're hoping.
Yeah.
Everything seems to come out Friday evening, so we're hoping that.
Yeah, they like dropping info Friday night at like 9:30.
Yeah, maybe this Friday or no later than next Friday, because I believe they're on recess after that.
Yeah.
All right, we're closing the polls in 3, 2, and 1. Back to you guys.
Okay, so when you fill out the application, you're going to have to focus on the salary. We're not going to spend too much time on this, but the salary and the wage reduction. This only applies to people who were paid less than $100,000 in 2019. So they're the ones who are subject to a reduction. Really, if their clients don't reduce anyone's pay beyond 25%, you don't have to worry about this. But if they do, then you have to run through the complicated process of figuring out, well, if they cut the salary, how much, and then you run through this formula that we have on the screen, and we have an example. So if somebody, you take essentially the percentage that their pay was reduced, and you find how much they should have been paid, and then that is your reduction once you take that over the 8-week covered period. So you annualize that as well. And the math is there. It's just a calculation that you have to run through. Nothing crazy, clearly defined in the instructions for the application. So what you're looking at is, did you decrease the pay of your employees 25%? That's what you're going to want to ask your client, and that's what you're going to want to see. If you're communicating with them, I understand times are tough, but if they got the PPP funds, they really shouldn't be doing that. There's no reason to do that and subject yourself to any type of restriction. There is a safe harbor for that as well. As I said, if you choose 24 weeks, you have to maintain those salaries above that, any type of 25% reduction all the way through the 24-week covered period, okay? That's the only caveat with applying early at about 12, 13, 14, whatever it is before 24 weeks. And this is based on those salary levels in the first quarter of the year. So that's where you're looking at what their pay was and was there a reduction. That's the window you're focused on, beginning of 2020. So the logic for calculating an FTE, it's quite complicated. And there's a few examples where clients might fall outside of this. And just because we had one client who has a standard work week of 37.5 hours, I know everyone only works 37.5 hours. Per the actual rules, they are subject to some type of reduction. But this 40 hours is for hours paid. What you do is you determine throughout the covered period, whether that's 8 weeks, 12 weeks, whatever it is, the average hours worked per week, and you divide it by 40. You're going to round to the nearest tenth. So the maximum value anyone can have is a 1. There is another calculation for folks who maybe have clients who have a bunch of employees who work different schedules. There's 2 different types of logic that you can apply. So one of them is you just want to make it easy. Anybody who didn't reach 40 hours are a 0.5. Anyone who did, they're a 1. Otherwise, you would use all of the rounding to the nearest tenth under the other method. You can use either one, whichever one, of course, you want that yields the largest FTE count, because that's going to be beneficial throughout all of the calculations. We have a small example here that shows that, and it's, if you look at the 2 methods, the kicker here is employee C, who works 28 hours, and that's the difference between the 2 situations at the bottom of the screen. And if you use the first method, you'll see that they get a 0.7, which yields a total FTE count of 3.7 versus the alternative method where you just call them 0.5, and just, there's the only 2 options, 0.5 or 1. And that's going to be all, this is all filled in that FTE chart that we showed you earlier for all of your employees. This is where you plug that value in of 1 or somewhat, or a little bit less than 1, and you're going to total it all the way down. And that's how you calculate your FTEs. Notice it's based on all the hours. For the example that I brought up where somebody was at 37.5, I think my recommendation would be pay them for 40 hours, because the actual rules of this program say divide by 40. They have total disregard for whatever your standard work week may be. I think a good way to manage that would be, if whatever their salary is for 37.5 hours, pay them an increased amount for 40 hours, and then you shouldn't be subject to any type of reduction. But this is also based on other periods. You'll have to look at the numbers, how this compares to the windows that they make you look back at to measure your FTEs versus now in your covered period. Christine, we have another polling question.
All right, you got it, Tom. Poll question number 3 is up on your screens now.
Yeah, so this is something we cover at the end of our presentation. Where do you guys, where is the answer? What answers do you need from the SBA? We know they're out there. And more so, I think SBA is waiting right now on Congress. Congress, if you read any of the news articles coming out, this PPP is getting thrown around, tossed around with the stimulus bill. Any stimulus bill that they could potentially deliver this week or next, I'm not even sure exactly of their session dates, but it's coming here soon, could include adjustments to the PPP. We've seen, we have a slide on this later. They're looking at maybe making all loans $150,000 or less automatically forgiven. We can't move forward with doing all these applications until we get an answer on that. So even if it is a rumor, you kind of have to give it a little bit of credence, I guess, because it could change it all, and we don't know what Congress is focused on.
All right, closing the polls in 3, 2, and 1. Back to you guys.
Thanks. So the FTE reduction, these are the windows. So when you are doing this calculation, you're going to look at 2 periods, and this is where you're going to measure your FTE count. So you have to do that silly 40 average hours worked per week divided by 40 logic for each of these windows. And you want to pick the period that gives you the largest value. So you can look at February 2019 through June 2019 and run the math there, and then compare that to the beginning of the year through February 29th and apply that logic and see which yields the greater FTE count. Again, it can get math intensive. A lot of CPA firms, ours especially, we've created spreadsheets that help calculate this and kind of formula driven to take this easier off of a lot of clients. So I strongly recommend that you either take ours, take another firm's if you can find one. There's AICPA has one readily available if you're a member there, and use those to help clients who have to run through this math. As I said before, the main point with this, and if you go through the logic in the application, how it really comes down is you're looking at February 15th, 2020. Whatever payroll period included that is where you're going to be looking back for purposes of the safe harbor. And then if you go through the window logic, it always comes down to, well, what were your employees at February 15th, 2020? That's just an inside tip. You can go through the logic, but I believe 99% of the time you're looking at February 15th. As I've said multiple times, you're looking at the date for FTE reduction at either the earlier of your date of the application for forgiveness was submitted or December 31st. That's the drop dead date, the last possible date that your employer or your clients can have all of their employees back, because hopefully everything will be better before the end of the year and everyone's back to work. That's how that works. If they're subject to an FTE reduction, they have multiple chances. They can wait till they apply to get all their employees back and then negate that entire reduction, or they have all the way till the end of the year to get their employees back to the counts that they were at February 15th. That's how that works. Here's exceptions. I went through these briefly. There's a few positions. There are circumstances where employees turned it down because that unemployment, that enhanced unemployment, I should say, was just better than their pay. If they rejected your job to come, your offer to bring them back to work, document that. It's going to be important to submit with your application, and you won't be subject to any FTE reduction. Fired for cause, no penalty for the clients. Voluntarily resign, no penalty for the clients. You just need to document all of this that happened, the emails, the resignation letter. Hold on to that. It's going to be important if the loan forgiveness application were to be looked at. Again, we emphasize written documentation is key. And then there's also the newer restriction that was introduced by the Flexibility Act that essentially says if any federal, state, local guidance prevented your business from returning back to levels pre-pandemic, then you can use this exception to get your entire loan forgiven. You're going to have an argument there. You're going to have to be able to prove that, and it's different for every single business, how they were negatively impacted, whether it's as simple as being shut down or their business is something that is tied to something else in the economy that has really been hurt. So we wanted to talk also about utilizing these loans. Our stance is, John and I agree, from a business perspective, there's little reason to not utilize this program. If your loan's under $2 million, they automatically say you are assumed to have a good faith need. And back in March and April, things looked pretty grim. There was a lot of confusion. I think every business should be able to say, I was trying to do the best thing for my company because I don't know how it was going to turn out. Companies may have ended up doing well, and that's fine. But I think it would be really hard for the SBA and any of the banks to argue that, oh no, you were sitting pretty back in the middle of this pandemic. I think that's an unreasonable argument. So that's our stance. Utilizing these is good business. My next bullet point, the optics, the brand impact, it could be bad, okay? You saw in the news there was Shake Shack getting targeted, Ruth Chris getting targeted, saying these companies don't need it. And you know, there's wealthy individuals who are using these funds. All of that aside, the politics and the ethics, the information does get released. But is it good business? Maybe. That's for the clients to decide. And so that's just something to think about. The optics are there, the names get released, but the perspective is very different for business owners versus someone looking in from the outside. Just something to think about. Next, the Flexibility Act made all of this easier. Flexibility Act introduced 24 weeks, introduced a longer maturity, and gave everyone more time to apply for forgiveness, to utilize the funds. That was the whole logic behind the bill. They even reduced the ratio for which had to be used for payroll. Congress stepped in and said, no, I want this to be easier because things aren't getting better as fast as we thought. If this program gets easier to achieve forgiveness, it makes it even more of a no-brainer to utilize. And last, in theory, how this does actually work. If you try to have to explain this to your clients, these businesses could have been entirely shut down, received a PPP loan, and then paid all of their employees based on that prior information and have been able to obtain full forgiveness. It's hard for business owners to understand, but it would be paying employees to sit at home. And that could have been the situation for some businesses.
The whole intent was to keep people on payroll.
Yeah, that's the point, keep everyone paid. And doing that is in tune with the bill. That's how it was designed. And a lot of businesses couldn't comprehend that because it is backwards. It's backwards logic. Some of our tips. This is from us, our recommendations to you guys as practitioners. What do you do when you're starting to go through these applications for your clients and assist them? Don't rush. We've told you that Congress is focusing on this and it's going to change. I'd bet some money on it that it would be changing here in the next few weeks because Congress is looking at ways to stimulate the economy to make this easier for business owners. And this program is that method in which they're doing it. So as things change, there's no reason to rush this application. you've got time throughout the end of the year. Businesses need to sit tight in our recommendation and just see what changes. Most importantly, there's the rumor, the potential for loans under a certain dollar amount being entirely forgiven automatically. I think that means they'd submit an application saying, can we have forgiveness, please? And they don't need any documentation. Granted, they could probably still be subject to review. I would wager that would still be allowed for the SBA to come look at it if they wanted to. But I think a large number, especially for sole proprietors and businesses that receive smaller loans in comparison, they're just going to make this easier and say, take it, take the money, it's going to be forgiven. That would be in tune with what Congress is saying right now. So that's something you're going to have to watch. Paid or incurred. This is less important now that 8 weeks isn't the only covered period you can select. But previously, everyone was worried about fitting all the costs into that eight-week period because the math was kind of more expenses than would normally be incurred throughout 8 weeks under normal circumstances. So paid or incurred was the language that says payroll costs that can be included in forgiveness must be paid or incurred inside the 8-week covered period. That meant that ones that, as I covered it as an example before, if the payroll was incurred 2 weeks before you received your loan and then the pay date for that exact payroll period was inside the covered period, you can include the whole entire amount. And then on the back end, you could accrue all of the days that were in the covered period, just like you do any type of other accrual for any of your clients. So that's something to be aware of. It may come in handy. It's kind of negated with the 24-week period. We mentioned this, pending legislation. Congress is looking at it, okay? I don't know what they're gonna do. I wish I could tell you, but the things I've seen, they're looking at $150,000 loans automatically forgiven. That could change. That's just us speculating. That's just other tax professionals reading and hearing what the whispers are outside of Congress. We're based in DC. We're not that close to
Tom, on the second point, it wasn't the intent to penalize people for getting these loans. If they're not allowed to deduct these expenses, you really say I have on average a federal and state 40% reduction. And so if you receive $1 billion, you're really only getting $600,000 if you can't deduct those expenses. And everything I read is promising that they will overturn the IRS code and allow in this instance to deduct the expenses. And then it remains to be seen whether the states decouple from that, if it happens or not. I think this is one of the most important things that needs to be addressed. And I know they're trying to.
We've seen, I don't think Congress likes the IRS's interpretation that these expenses are not deductible. Yeah, to us as practitioners, that doesn't seem logical because free money and the deduction kind of seems like double dipping, but a lot of people disagree, and that's fine. But a lot of the tax lawyers are kind of already getting their weapons ready to fight this one out because there's a few problems like states are going to handle forgiveness of debt in different ways than the IRS will and the federal code. They came out and it had an interpretation of their own code that says we believe this can be non-taxable. And a lot of the tax lawyers are saying, no, the IRS is wrong per the, these court cases and stuff like that. So there could be something interesting happening here if it doesn't get addressed. Lots of people arguing different ways. It's important to go back to our first recommendation. Just wait, guys. Just try to see how some of this plays out and try to delay as long as you can, and convince your clients that it's for their benefit, because it really is. You don't want to go ahead and get something done too quickly. We have our last polling question.
All right, if you're hearing my voice, we have launched the last polling question. It should be on your screens. Please take a few seconds and submit your vote and let me know if you are having any issues.
I hope we answered a lot of your questions. I believe we do have an extra time for Q&A. That's right, Christine?
We are done in about a minute here, unfortunately.
Okay. All right, I'm fine.
But rest assured, our presenters will receive a copy of all the questions and feedback that we received during the webinar. So you guys will get all those questions just in case.
Yeah.
All right, we are closing the polls in 3, 2, and 1. Back to you guys.
All right, guys. So what we just had here was just a few questions at the end that we received from our clients. We're just going to discuss those. But since we're out of time, we won't get to cover that today. Some of them are very niche anyway. You're going to run into them yourself. You're going to have to diagnose them and look at all the rules and make your best interpretation. You're going to have to communicate with the banks. They're the ones who are making this final decision on forgiveness. All of the specific lenders, they're going to interpret things differently. They're going to have their own opinions on what's included and what isn't. So we have a tough road ahead of us. But as we said before, this PPP program, this pain is only temporary. Hopefully we can get through it soon. It's going to have everlasting problems, like some of these clients who are fiscal year, maybe at June year end. What do? It presents problems, and the timelines, they could start falling into next year and next year's income taxes. So we're just going to have to play it by ear and stay ready and stay agile. And I hope we gave you guys a better understanding of everything today. And I hope we met your standards. It's a lot of info. I wish we had 2 hours. But again, this is John Comunale, and I'm Tom Hudson. And we're from CBM CPA in Washington, D.C. And here's our contact information. If you have any further questions, by all means, shoot us an email. We'd love to help.
Thanks, everyone.
All right. Well, thank you, John and Tom, for sharing your time and expertise with us today. And for the rest of you, as a reminder, we will process the CPE credit, and that will be made available in your CPAacademy accounts within 24 hours, along with an archived recording of this webinar and a copy of the handouts. You should also receive a link to an evaluation for this webinar in your inbox, as well as your CPAacademy account. So thank you again to John and Tom, and to all of you for attending today. We hope to see you again soon. Bye, everyone.